Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and Independent Advisories. Sitting across from me, we have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, also the founder of internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business financial blog. We also have Leith Van Onselen, our resident Nucleus Wealth economist, who has spent time with both the federal and Victorian treasuries, along with some time as an analyst with Goldman Sachs. Leith now co-authors the widely read Macro Business financial blog with David Llewellyn-Smith. And finally, we have Nucleus Wealth's head of investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, of course, please check out our people section at www.nucleuswealth.com. So hello and welcome to this week's instalment of Nucleus Investment Insights. And today we're looking at the Australian debt crisis. And so we've put together essentially a bit of a playbook of the Australian debt crisis as it stands today, and some factors behind and reasoning behind why we think we're in a crisis, and obviously the impacts going forward. I'm joined today, as always, by Chief Strategist David Llewellyn-Smith. G'day, David.
G'day, Tim.
And Nucleus Wealth's Head of Investments, Damien Klassen. G'day, Damien. Fantastic. So we'll kick off with an agenda today. We're going to be just broadly looking at bubbles in general, classifying bubbles, what are they, and how do you know if you're in one? Then, of course, identifying what sort of bubble it could be and the conditions or prevalent conditions that sit behind that as well. As with all things bubbles, eventually they can end in a crash. So we'll pick apart potential, topics of and parts of the crash situation that we may be facing, and then finally, in response, of course, governments and industry potentially can rally behind and pull apart and rebuild. So we'll talk at length at some of the policy responses as well. So with no further ado, let's jump into it. We've got an overview, so let's kick us off with Damien.
Yeah, sure. I think the key thing is this is based around a book recently published by Ray Dalio. So Ray's a long-term hedge fund manager. He's sort of, I think, a lot of claims to fame, but basically he's written this book at the request of central bankers because he's got an extremely detailed model of the economy and a lot of his hedge fund has been spoken about as having better resources than the Fed in terms of looking at these economies, and so he's been asked to put this together, and it's quite a detailed book. It's sort of 500 pages long, and it goes into all the different types. And he's sort of hitting the book review circuit at the moment, and so you'll find him on a lot of podcasts and stuff like that. But what we wanted to do was isolate and say, okay, well, if we take his framework for looking at bubbles and actually apply that to the Australian market, what do we see in terms of where the Australian market sits, and what does that actually mean in terms of in terms of policies and things like that. We have he's sort of set up a few different categories he puts things into. So he's sort of got the early parts of the bubbles, and we've got a sort of a picture up on the moment, sort of showing interest rates, how they generally progress over the time frame. where you have this early cycle, then you get this bubble kicking along, then you get the top of the bubble as interest rates start to tighten up, and then you fall into the depression, which he sort of defines as a GDP down 3% event, and then you finally get into the beautiful deleveraging and the normalization type stage. So so I think the key things we want to do is jump into sort of this bubble classification stage. So we might jump to the next slide. So how he puts it together is there's basically two different types of financial crises that you get. You either get inflationary crises or deflationary crises, and the main difference is if you don't have control of your external debt. So then you end up in an inflationary crisis, like you sort of the Weimar Republic or a lot of the South American countries, some of the Asian countries in the Asian crisis sort of ended up in these inflationary debt crises. If you do have control of your debt and your debt isn't denominated in foreign currencies, then you generally tend to experience a deflationary debt crisis, and that's sort of it's an important point for investors looking at this, and also for policymakers, is that around the US, as the US market was going through its debt crisis, there was a lot of discussion about the amount of money that was being printed and how it was all going to end in tears, and inflation, hyperinflation was just around the corner, and Weimar Germany and Argentinian sort of inflation rates and things like that, But it's very important to note that depending upon how you're set up with your external liabilities, that's what really determines whether you're in an inflationary or deflationary, not as much the amount of money printing that sort of goes into this.
Okay, David.
Well, excuse me. I mean, the obvious corollary to that is, where does Australia fit? And that is, do we have control of our external liabilities? We certainly have them. They're quite large. In fact, they're very large relative to most other nations. About 60% of GDP, something like that, is bank borrowing offshore.
Yeah. Yes, and most of those liabilities are from the banks. So
yes.
We've got a large external debt, but most of it to the banks.
And it's useful to compare that with Canada, for instance, which has a sort of, is also seen as something of a housing bubble, like Australia, and an Anglosphere economy with not dissimilar characteristics. There are actually some big differences, and one of them is that the Canadian external debt is very small. And so they don't have this big external liability to worry about. The good news in that is that one of the reasons this liability took off is the Australian banks in the late 90s mastered the derivatives swaps market in interest rates and Forex. And that means that just about all of those liabilities are swapped back into Australian dollars. So rather than, even though we have a large external liability, we actually don't have it denominated in anything other than Australian dollars. So we are not like a banana republic, where if the Australian dollar starts to fall, our external liabilities explode. And then that's where you get into your inflationary feedback loops.
And so what that means is if we go through a debt crisis, then we're most likely headed for a deflationary debt crisis.
Okay, fantastic. You've just answered a question in that one. Thanks, Damien. Very good. Sure. And so I guess, and this is a commonly trotted out line when people say engage the printers. Is that just showing a bit of naivety that that there is effectively this? There is two sides of the coin when it comes to just firing them up.
Yeah. So I mean, there's a whole bunch of different nuances that go into this, and we'll go into more detail on the printing later. But,
sure.
But I think there's probably two things to note. Is one is that there's usually within these debt crises there's been a huge amount of credit creation, and the economy needs this credit creation to keep going, and just so that you don't go through, when you go through big negative amounts of credit, all of a sudden people can't operate their normal lives going in the normal in the normal fashion. So once you've sort of got to these stages, it's all about the central bank managing to basically step in and replace the credit creation with money printing. So if you did too much of it, you'll end up with inflation. But as long as they're just replacing the what used to come from credit with money printing, then you're all right. And it's worth noting as well that
I think it's also worth adding that despite all of central banks' efforts through the GFC, they got nowhere near printing enough.
No, that's right. Yeah.
So it remained highly deflationary.
Yeah, exactly.
So in theory, you could certainly print enough to create inflation in that environment, but nobody, despite the printing presses whirring like mad things, they got nowhere near it.
Yeah, and part of that's because your printing presses if you're printing presses to buy government debt, then you sort of run out of room, and that becomes at the start that's great, but eventually that it gets less and lesser effect the longer that goes on. Whereas if you're printing presses to get it out to the populace, then you can start getting that inflation going. But that generally hasn't happened in the last set, and probably wouldn't happen certainly in the short term in ours. And the other factor worth noting as well, whenever you get these crises, is a lot of it is about how far you want to shift this thing. So you basically go, we've got this big negative, and then you've a big negative hit. Say you've grown debt, and Australia's sort of grown debt by 20% of GDP faster. So we've gone from sort of we've increased our debt to GDP ratio, actually probably closer to 30% of GDP. So then you go, well, if I'm going to have a negative hit of say 20% of GDP, now do I take that all in 1 year and create this massive negative and the sky's falling and everyone's out of work and all that type of stuff, or do I just stretch that out over a longer period where growth can actually pick up and if I'm growing, inflation's a bit higher and I'm growing at 3 or 4%, I would have been growing at 3 or 4%, but now I'm growing 1 or 2%. And taking a 2% hit every year, then it becomes more manageable.
Okay.
Yeah. Okay. So that's the inflationary, deflationary side. The next most important thing, and especially for Australia, is it a long term or a short term? And what I mean by this is I've got up a chart showing private debt to GDP and public debt to GDP for Australia. And it goes through short-term cycles as well as long-term cycles. So this is sort of over 100 years, and we can see these big rises and then big falls. But within the big rises and big falls, there's also small rises and small falls. So and the small rises and small falls are the typical economic cycle. So you go through an economic cycle and things go well, and then you slide off a bit, and then go up and down. But it's important to note that we're actually in this broader-based, really big trend upwards. And so every time the market starts to turn down, the question has to be, is this the big one? Is this the time where the long-term debt trend all of a sudden starts to normalise, or is this just another little blip in the sort of is this just another short-term cycle trend? Okay. And so I think there's no one knows the answer for those, and I think most people thought that come 2008 that Australia was headed for we'd been through this long-term trend, and we'd also had a short-term uptrend, and that finished, and that we were going to the long-term debt trend was going to normalise, and then China stepped in with one of the biggest stimulus packages we've ever seen, and it was happy days for the Australian economy, and on we went. So we think the next big one, or certainly the next big external shock, will be enough to bring on the longer term debt crisis for Australia. But maybe we'll get lucky again. We've been lucky a number of times, and so it could easily happen again, and the next blip could just be another short term downtrend, and then you resume the upward. But based on most of our measurements, we're certainly reaching the end. We think the next one will be largely a transfer. So you can see on this graph that the private debt is very high, but the public debt is still quite low in Australia. We think the next crisis will be a shift where basically you bail out the private debt by increasing your government debt, and then you've got 10 years down the track, you've got another major issue, which is okay. Now we're stretched on both these measures. Okay. And I think there's a few countries around the world where that's true of as well, and probably the US. They're certainly at the moment everything's humming along and all that, but they have increased their government debt, and it's pushing up to certain levels, and private debt's starting to lift off again. So it's a question of sustainability and when you hit that longer term.
Okay, sure thing.
I mean, the main reason we think that this will be probably the long-term reckoning. For instance, I didn't think the GFC would be for Australia. In fact, I advised people to buy housing in 2009. This time I think it is the long-term reckoning, and it's really about interest rates. We've simply run out of room on interest rates. We've hit the zero bound, and that's a typical signal for when you've run the gamut on what's possible in terms of your debt stock.
Yeah.
And we haven't even. We'll get back into that, I guess. But
yeah, we'll go into that and some more detail about science. We're sort of hitting the end.
Yeah.
Okay, so we'll roll into identifying bubbles.
Yeah, so it's important to note that bubbles are a lot of debt bubbles are by their nature self-reinforcing. And what I mean by that is you get this sort of this upswing where banks go out and lend money to people to buy houses, and the value of those houses go up, and then people take some money out of that and they go and stick it into another house, and the value of those houses go up, and then they're getting more income, and everything's sort of this. Everyone's happy, like it's just sort of this real rising spending, rising incomes. Borrowers can lend more.
It's effectively just a wealth effect, really, isn't it? Everyone's getting richer.
Absolutely. Well, everyone's getting richer on the back of debt.
Yeah.
So you're increasing your debt. So you're basically saying, my ordinary income might be $100,000 a year, and I'll borrow and turn that into $110,000 a year to do all this investment, and that's working great. And I keep building up this big debt to back that. My income keeps rising, and then eventually, at a certain stage, it goes into reverse, and now that's where the danger starts to happen.
Sure.
So we've got bubbles that are self-reinforcing, and we think that Australia sort of fits that mold very much in terms of what's been going up keeps going up and helps the whole thing to kick along, and more real estate commissions and more money for governments in terms of
stamp duties
and stuff like that. The next thing that bubbles usually have is new financial instruments. So there's basically when you're trying to get debt, when you've got these debt-driven bubbles, you need ways to shovel more and more debt out to people. So Australian debt has been rising much faster than Australian incomes, and so you need to, if you're operating under your old scenario, which is people need to have income to back the debt.
Yep.
And you've got certain characteristics, and they're only lent through banks, then it's very hard to shovel enough debt out there to actually get to grow this thing. So what usually happens in a lot of other countries is you get these new financial instruments. So in the US we saw CDOs and ninja loans and all these things like that sort of got really shoveled that credit out. We haven't, and a huge shadow banking sector, they call it, which we haven't really seen in Australia. So what's tended to happen in Australia is our new areas, for my part, look, we had some tax changes which helped in terms of negative gearing and your but mainly your capital gains.
Yep.
We've had self-managed super funds, so we've let people tap into their self-managed super funds to put more in.
Yep.
There's been a decent influx of big influx of overseas buyers, which has helped out, and then and so all that's meant that's managed to funnel straight into the banking sector still. So most of our loans are still sort of tied up in this banking sector. The two big ones for the banking sector is they've been using what's called the HEM, which is, David, you'll give me what's that actually stand for?
Household expenditure measure.
Yeah, there's basically a poverty measure where you basically use
it's a base case, isn't it?
Base case, yeah,
applied for everybody.
So somebody rolls in and says, I've got a lease on 2 different BMWs, and I've got my 3 kids all in private schools, and I've got a huge house and all these expenses to pay, and we take annual skiing holidays. And then the bank says, oh, okay, well, if you were living on the poverty line, you would need, $400 a month. And so that's what we'll put in you for expenses. And now you can borrow 10 times as much as what you would have if we actually had put in your real expenses.
Yep.
It's actually based on an ABS measure, the HES, H-E-S, but through chicanery of one sort or another, it somehow ended up being about half what the HES is. So it really is a grotesque underestimation of typical household expenditure.
Yeah, and so that's how we managed to shovel all this credit out. Because if we had had to say, Tim, what's your real salary and what's your real expenses? There's no way we could have lent you that much money, but we've managed to do that. And the other thing is there was a fairly decent change in the interest-only lending as well, where there was a lot more interest-only lending done to investors.
I'll just add, I think the HAM tax changes at SMSF would have been running since the millennium.
The SMSF wasn't that long ago. No.
Maybe not. Well, certainly the tax changes. I'm not sure how long they've been using the HAM.
Well, the capital gains was sort of mid 2000s though.
No, they did that. They did that in 1999 as well.
Oh,
it was
okay.
Howard, yeah. But the ones that really, the new instruments that, like post 2011, when this blow off bubble, really took off.
Yep.
And it was very difficult to get going. They struggled for 2 years to really fire it up, even though they slashed interest rates. The major new instruments in this one was interest only, and the Chinese cash.
Yes.
They're the two that really went nuts. Now you can't really call Chinese cash a new instrument, but it was certainly and it's not actually debt, but
it is a new source. I think that's Dalia's main point is you need a new source of demand for these assets.
Yeah, and it was, and even though it wasn't debt, it nonetheless was highly risky, and we're now seeing that after China shut its capital account, not only has that flow stopped, in some places it's reversing quite fast.
And that makes sense, obviously, with house pricing being a marginal sort of thing. It's all set on the margins, isn't it? So if you just keep adding people that think that the margin should be here rather than here, then vis-a-vis China,
and that's
to the moon.
Exactly, and that's especially the case if you bring in very wealthy people from elsewhere looking for a bolt hole that have different motivations and much higher levels of cash to throw in, so it shifts that marginal buyer materially.
Yeah, my take as well. I've sort of cynically said, if you're a pious government employee of a nameless country who'd managed to, just through being a normal government employee, managed to get a few $1 million worth of thing, and you're worried that maybe if there was a corruption crackdown, you might lose that. You'd be more than happy to use that to buy property in Australia, even if you're going to lose money on the deal. You might go, well, if I threw $2 or $3 million into that, and even if I lost, a couple $100,000, it's far better than losing the lot. If I kept it in my home country where they might discover, how a pious public servant managed to get that much money.
I mean, if I had to characterise what happened in this blow off, I would, as I said, they started slashing interest rates in 2011. Housing did nothing for 2 years. It didn't take off until 2013, until the Chinese money hit. And I think what happened then was Australians were priced out almost instantly, and the only way they could chase it was with interest-only loans. Right? They had to erase principal from the equation.
Yeah.
Because we got priced into an entirely different regime. That's more or less the story, I think.
So let's hit Dalia's checklist then, which is on the next one, which is his. So basically, he's got a bunch of things, a whole bunch of different ones. US in various different measures. Some of the Japanese crises and Greece and Ireland and places like that. They're basically saying, well, are prices high relative to traditional measures? And you go, yep. They pretty much are. Prices discounting future rapid price appreciation, and again, I'd say, well, if you're buying property on yields of 1-ish% and lower, I guess net yields of even lower than that, then
10 times your income.
Exactly. You've got to be assuming that the prices are going up to be able to justify buying. Are purchases being financed by high leverage? Absolutely. Are buyers and companies making forward purchases? Look, not that much. I think they sort of go through the different markets, and some are, some aren't. I think Australia's sort of a little bit grey in that area. There's certainly a lot of the buy off the plan. I think we're seeing that started to happen now, where people are failing on they've basically put down money on a whole bunch of sort of bought off the plan, stuck down 10 grand with the idea that I'll flip it and find another one as soon as it comes up.
Absolutely.
I think you can say that's quite big, actually, in this blow off. Like, the level of apartment construction across the East Coast is all buying future. And that's actually only just started to settle. It's got another 3 or 4 years of settlement ahead.
Yep.
Into the bust.
Yep. Number 5, have new participants entered the market? Absolutely. We spoke about that a minute ago. 6 is their broad bullish sentiment. Absolutely. I think if you read any newspaper for the last 5 years, maybe not the last 6 months, but certainly times before that, there was certainly discussions about property doubling every 7 years or whatever. You just needed to. It was just
buy and hold.
Yeah.
Just buy and hold.
Yep. And then buy some more.
Yeah.
Leverage and buy some more. Yeah.
Well, the New South Wales Planning Minister came out and said all you need to be set for life is to buy a Sydney property. He said that almost on the weekend the market topped. But, that was where the sentiment was.
Yep.
And then finally, does tightening risk popping the bubble? And absolutely, I think the tightening of credit we've seen without interest rates rising has absolutely seen the that come to bear.
Sure.
So it's worth noting as well that there's just a few. So we're in these identifying the bubbles and also working out the concentration. So if the concentration is broadly spread across the economy, it's less of a worry than if you've got sort of really concentrated in particular areas.
Yeah, right.
Because you basically want to go, well, if something blows up and everyone takes a little bit of pain, that's all right. But if it blows up and you've got a large portion of the population, a more concentrated population, 10-15% of the population are leveraged up to their eyeballs and are really going to suffer, then that can affect things more than everyone taking a little bit of pain.
That's a really good point, I guess, because obviously Melbourne and Sydney are the epicenters of this housing call off. So okay, fantastic.
Yeah. So arguably that's possibly a slight positive for Australia in that WA and Northern Queensland has seen some of the declines already. Rather than having every housing market all fall over at the same time and all of a sudden everyone go, wow, that's we never knew that was coming. So it is slightly beneficial, but in the end, it's the speed of the decline and things like that make the biggest difference.
That said, the blow off was very concentrated in Sydney and Melbourne.
Yeah.
Which is
at present.
Sorry?
At present.
Well, the blow off from 20
blow. Oh, sorry, beg your pardon.
Yeah, not the blow up. The blow off was very concentrated in Sydney and Melbourne. Extremely so, much more so than it's ever been before. I think Melbourne, relative to every other property market in the country, reached its most expensive in history at a point. So we do tick that box as well, Damo.
So let's go to conditions. So we've sort of identified, yes, we're in this bubble and it's a deflationary bubble. We think it's a long-term one, and we're sort of ticking all the boxes of what's happening.
There was actually just a quick question on that note. So if it is going to be a long-term bubble, how can you be so sure that the powers that be, including overseas powers, can't reach for more stimulus and just kick it along all over again?
They absolutely can.
Oh, there you go.
The question is how fast they get there, because if they don't get there fast enough, and then they can't kick it along. And actually, we'll go into that in a little bit more detail. How can we kick this along? How can we kick the can a little bit further down the road and give ourselves a little bit more breathing room?
Sure.
And how far can it be kicked?
Yeah, that's right. Okay, so the next thing is this conditions side. So this is just sort of saying, look, when the bubble's happening, what typically happens? So typically you'll see leveraging up about 20-25% of GDP over sort of three plus years. Now Australia, we've seen private debt up about 20% as a percentage of GDP, and public up about 10 over 5 years. So we're certainly in the, so it's been a little bit longer. It hasn't been quite as steep, but it's certainly been increasing. They talk about total debt to income of about 300%. So the issue for Australia is the government lending's really letting us down. Those guys haven't been borrowing as much as they could.
Oh, come on.
Yeah. So I'm sure. I think they'll probably fix that as the crisis hits. But I guess that's one thing where we are slightly different, as we're not. The government does have scope to take on some of that. They speak about the yield curve flattening by sort of somewhere between 0.9 to 1.7. Now, our yield curve just meets that over the last 5 years, but it's probably not. I wouldn't call it. I wouldn't call it a huge flattening. It's certainly flattened, but it's not.
Give it 3 months.
Yeah. Well, that's right. Because we're not quite there on that one. Equity markets extended a rally, so I'm working backwards through these checklists. Look, our equity markets, if you went from 2012 and included dividends, you can get 100% return from there. In terms of the debt growing faster than incomes, absolutely. Income growth, they talk about it being high but slower than debt. Now that's probably our weakest point in terms of meeting the conditions. Is income growth we wouldn't call as high. It's been high if you do it on a total basis, but on a per capita basis, it actually hasn't been that good. But I think we fit pretty much all those criteria. Income growth and yield, we're only just scraping in, but we're sort of we fit the condition of that. Okay, we're into this bubble, and where are things going? The next point is very important. Is that he makes the point that in many cases monetary policy helps inflate the bubble rather than constrain it. And we'll move on to later on what we should have done. But I think this is certainly true over as the RBA cut rates. Almost explicitly with a view of we're coming out of this commodity boom and we need to find something else to replace it, and so here's this housing boom that's going to replace it.
Yep.
And so from already relatively elevated, relatively expensive levels, it got inflated, even further.
Very explicitly.
So
Glenn Stevens went from early 2010, it might have been late 2009, going on Sunrise and telling households that the days of debt were over, and it would be dangerous for the country if leverage were to rise any further in households. To about 18 months later, maybe 2 years, doing a complete backflip, shredding interest rates and just unleashing hell, basically, and explicitly saying, go for it, we want a housing boom. So did Treasury. They did it. They decided it together.
So for that,
it was basically because they'd overestimated the duration of the mining boom, and so when it went bust, they had this huge capital investment cliff that was going to cause a huge recession, and their best idea to offset that was to just tear it up with housing again.
Well, and it kicked the can.
It
so,
did.
Yeah, absolutely.
And here we are.
Here we are. That's exactly. Here we are. The question is, what else? What's the next? Can we kick it any further? And then what are we going to use next?
Yeah.
Okay. So then you come into this crash side, and you go, well, what are the proximate causes of crashes? And I guess remembering that we spoke about these self-reinforcing bubbles, and so then when it all turns the other way, everything goes into reverse. Property prices fall. People have to sell properties, revalue their next ones. All of a sudden, they're missing, missing equity, and they can't afford it. And all banks are telling them, no, we're not going to lend to you on, your interest. We're not going to lend to you on an interest-only basis anymore. Lenders, investors start to withdraw money from banks and things like that. So we're only just at the very early stages of this. But I think for my part, they're sort of like we spoke about what the sort of causes of some of the causes of this final sort of blow off. So the first one, the income assessment and the HEM. So that's flipped around with the Royal Commission. So now we still don't really know where that's going to land in terms of how strict they're going to be with it. But the initial stuff from the Royal Commission was being very strict. The flip side is Treasury and RBA are pushing back quite strongly, trying to convince people that they shouldn't be very strict because they need this credit to bounce around still.
Yeah, they'd like to see the criminal banking continue, but Hayne has been quite stern on it, and to me it looks like it's going to land fairly conservatively, I think.
Sorry, when you say conservative, what do you mean by that?
In terms of tightening,
right?
Like I don't think it's going to become a severe constraint on credit, but I think the activity of the banks themselves is telling us where they think it's going to land, and we've seen reasonably fearsome tightening from Westpac on its lending standards, preparing for a new regime, and more to the point, ANZ this week came out with virtually draconian new lending standards, assessing income, expenditure, and what have you. And they have clearly decided, their lawyers are telling them clearly that the HEM is going to get crimped pretty big. you know, the UBS assessment, and they've been, you know, Jonathan Mott's been far out ahead of everybody else on this. He thinks as well, roughly the same as me. It'll land somewhere on the Hayne side of the spectrum, but not at the outer edge.
Not maximum Hayne.
Not maximum pain, but pain.
Interest only. So that was an APRA decision to sort of limit the amount of interest only lending. So that's now we're going through this reset period now. So that's starting to affect as people are turning up and saying, "Oh, yep, my 5 years just finished.
I'd like to go again."
And the bank's going, we want some principal paid off now. So that's sort of gone into reverse. That could flip around. You know, things.
There is some good news on that as well, where insofar as all the banks have showed quite a lot of progress in churning through their resets. Like, they're all about 6 months ahead of what you'd expect in terms of just the schedule reset. Because it's $400 or $500 billion worth of reset we've got here. It's bloody enormous out to 2021, and here we are at late 2018, and we're already kind of we've eaten well into the 2019 schedule for reset. So there is actually positive news on that front, but it does continue for years, and there's an enormous amount to go.
Yeah, and while you could flip it, so this is one of those ones where if you pass your tipping point or not, where you get to the stage where you could see APRA turn around and go, okay, that's fine, banks, go for it. You know, get the interest only lending as much as you want out there to try and help prop things up and avert disaster. If that's early in the piece, then that might work. That might get investors back in, and you know, some interest rate cuts and things like that. If you wait too long though, and all of a sudden there's blood in the streets, and you know, stories about people getting kicked out of their houses and lost this and lost that, which we're starting to see certainly the initial elements of that. Then you get to the stage where people are trying to all these guys are trying to shove debt down people's throats that people just aren't interested in taking. They're saying, they look and go, well, yeah, I know you want to give me cheap debt and all these benefits and things like that, but I'll just wait a year and come back then.
Hayne comes in here too, where APRA is under a lot of pressure from the Royal Commission to clean up its act, and we don't really know where that's going to fall yet either. And then of course you'll have a new government. We're busy campaigning to get another inquiry going on the regulators and their role in the entire debacle, but you know, the APRA's still going to have to appear, it appears, at the Royal Commission in the last few weeks, and it's, you know, clearly under a lot of strain to not go back easily and do interest only again, for instance. Like, you know, its reputation really is on the line now, very publicly and you know, in a legal context, and again, there's also quite a lot of class action movement around interest only. So the legal questions that come out of Hayne may also determine whether interest only combined with the HEM was predatory lending, and so it's quite possible that even despite all of the efforts of the regulators that want to see freer credit, that if you get a relatively conservative assessment of these things from the Hayne Royal Commission, then private class actions may simply take over. You know,
maybe. And I guess
it's one possible scenario.
Yeah, that's right. And I guess what I'm thinking though is, in a outright debt crisis, one of the key tools governments have is to change the laws and change these things to let people shovel out as much. And
this is more goes to your point about, can it be done before the crisis comes?
Yes, yeah.
Right? And I don't think it can. What I'm arguing basically is that they're so self-interested at this point that they're unlikely to be making preemptive moves that might head it off.
Yes.
And by the time they do panic, it may well be too late.
Yes. No, I think that's the right assessment. Tax change. I'll flick through the restaurants. Tax changes. So we've got the Labor government talking about some tax changes that aren't going to make things better. SMSF lending is probably
Labor's going to ban it.
You think so? Right.
Sorry, they've said they will.
Yeah,
it's on the books.
Yeah.
Comes in with negative gearing and capital gains reform.
Yeah, and you think that'll carry through? I guess that's the question: is whether some of these will get backtracked on.
Well,
we don't think the negative gearing, because they have come out several times to say the negative gearing's going to go? We're going to stay.
Look, I mean, who knows? I suspect by the time they win the election, the nation will be in near chaos, because I think Sydney property prices will be down 12-13%, probably accelerating. Unless the RBA is cut before the election, which would be very difficult for it to do. I certainly think it'll have to cut afterwards. The economy will be stalling. There'll definitely be a sense that falling house prices are starting to tip into falling consumption, so it'll be hitting the macro. In that environment, what is Labor going to do? I mean, throw your chips in the air.
Yep.
I mean, if I were them, I'd probably do it. I'd do it straight away, though. At the moment, they're talking about doing it out in 2020.
Yeah.
And I'd just slap it in.
Blame it all on the libs.
Yeah, blame it on the libs, and just put a gun to the RBA's head.
Yeah.
And just say cut, and cut taxes as well.
Yeah.
Which they'd be able to do.
Anyway, let's. Yeah.
So I still think they'll do it. But
it's uncertain.
It's uncertain, absolutely.
Yeah.
We can talk about that a bit later anyway. We've got some policy responses in there.
Yeah, Chinese buyers, look, unlikely to come back anytime soon. I guess if you had a rapid resolution of the trade war and all of a sudden the Chinese yuan recovered and shot up and they wanted to try and get some more money out of their, they wanted to cool their economy down, they might ease up and let people take more money out. But I think
it kind of sounds
horses bolted.
Yeah, it kind of sounds like they've got their head around this capital control business as well. Yeah, so it's rorted, it's closed, it's rorted, it's closed, it's iterated itself to maybe having an impact.
Yeah, I think it's closed at the moment, but pretty closed at the moment. But there'll be, there's self-interest. Everyone's busy working on how to get around it. And the worse things look in China, the more people will be keen to get money out. But I think for the moment, we think the Chinese buyers have gone.
I think it'll get worse next year. I mean, of course, there are other scenarios, but at least the way things are going, assuming Cold War 2.0 continues, China keeps slowing, is forced to cut interest rates eventually. It's desperately trying to avoid it, but may be forced to. Then the yuan comes under a huge pressure to fall, and then.
So you want as many capital controls as you can at that point.
Yeah, that's right. And people are actually starting to talk about constraints on the trade account as well,
right,
to protect the currency. Like if the capital account remains too leaky, I've started to read analysis that will say they may start to restrict tourism,
right,
and students going abroad, because that's a very easy way of keeping yuan in the country.
Interesting.
Yeah, so the last
obviously if that happened, that would be another nasty blow to Australia.
The last one, rising interest rates, is usually a cause of crashes. In Australia, it's a little bit different in that it doesn't look like it will be a cause of it. It is noted. I mean, we wouldn't be the only sort of debt crisis. If we go through this debt crisis, we wouldn't be the only country that's had a debt crisis without sort of higher interest rates causing it. Quite often, but quite often the other ones are externally driven in terms of. External creditors start to come to the point where they're going, okay, we're not going to keep funding this economy with, and they're the ones sort of clamp down on credit. But in the end, the idea is if there is a clamp down on credit, whether that be through interest rates get too high or credit conditions themselves, the availability of credit shrinks. That's what usually causes this crash, and that's where we certainly see ourselves going through that stage at the moment. The big question is tipping points, which is sort of the next slide. Is saying, well, when you hit there's a tipping point where you say prices have fallen far enough that where now the losses are large enough, the psychology's turned in the opposite direction, and there's no getting this thing back. And that was come back to the question we had earlier from a listener was, can you hit the point where can they kick the can further down the road? So there's sort of three points to this. One is a flattening yield curve. So flattening yield curve basically means that it encourages people to stick more money in cash, and that sort of that helps bring these things to an end as well. Domestic conditions are the part where domestically we are pulling back on credit. The question is, will that be enough to actually tip us over past the point and send us into this downward spiral? And we don't know. Yeah.
I'll just add a couple of things on that one. I'm quite concerned that we have this very unique convergence of negatives over the next sort of 6 to 9 months in terms of domestic conditions. Things are fine right now. Like, we've had good growth, although it's starting to slow appreciably. And the labour market, the jump numbers are good still today, but the leading indicators for the labour market are definite softening. And we're going to go into what is a pretty weak Christmas with the Victorian election, which is going to slow things down here. Immediately in the new year, we get the Hayne Royal Commission recommendations come out in February, which will be chaos. Straight into a New South Wales election, chaos. Followed by an early year budget, election budget, federal budget, chaos. It's likely to cut immigration in that budget. It's already mooting that. Chaos. Then into the federal election itself in May, chaos. And if you look at the way all of these things impact domestic conditions, domestic demand, they all slow it. And so you'll have this extraordinary period of uncertainty with house prices falling at the same time, and you could reach kind of May or June with, because you've been in this fog, right, of uncertainty, so, tightening credit, falling house prices, slowing economy, you could very easily find yourself in a position where you have got a feedback loop going by May, June next year. Now, you could come out of that with a new government, some new stimulus, some tax cuts, the RBA cuts, etc. They might be able to turn it around again. But it's hard to look at that 6 or 9 month period of blows to confidence and not be concerned that could be a tipping point.
And my example from a company's perspective is, if companies looking at a $100 million, $200 million spend on whatever, new factories, new infrastructure, whatever they're looking to do, if they've got that sort of sitting on their plate at the moment, and they're looking at the government, not quite sure what the rules and regulations are going to be, it's a pretty simple matter to say, look, this is a long-term plan, this is going to last for 20 years or something like that. Let's just wait 6 months and check out what happens, and then we'll go and spend that money. So you see a lot of that, just where people are, finishing off existing projects. But the thing, do I start a new project? So, well, let's wait, see what comes out.
That sounds good. Okay, finally, external
shock. Look, we think an external shock would be enough to kick us into the downward spiral.
So examples of an external shock that could do it.
The GFC.
Just recession into US.
So mainly US driven, you'd think.
.com bust, whatever it happens to be.
Yeah. So we think
European crisis.
European crisis is probably the most likely one shorter term, or Chinese. Big slowdown in China. We think at the moment we're probably all right for that. We think it's late cycle, but it's hard to tell. But we think there's probably still another 6 to 18 months or so to run. It's hard to pick an exact time frame. So we think that an external shock certainly would be enough. But the bigger question, as David said, is without an external shock, are just internal conditions enough to send this down? And maybe there might be.
Okay, sure thing.
Right, so it's a tipping point. The lessons Dalia has for when you do hit a crash is that the more leverage and the higher the prices go, then the less it takes to tip you over the edge, and the worse it's going to be. The big thing is that in a normal recession, you cut interest rates, and that sort of helps because the more money gets out there, and positive wealth effect, and stimulates economic activity, and all these sort of positives that get you through, and off you go into the next one.
Yep.
The issue is now we're close to this zero lower bound, where as David spoke about before, that there's one of the key reasons for saying, can this be the big one? The reason why it can be the big one is because we haven't got any room left on the interest rates.
Yep.
Or we haven't got very much room left on interest rates.
And on that note, obviously, so we're talking about the RBA just reducing. Is zero the lower bound? Do you think is a zero lower bound? Is it actually zero, or could it be something a bit higher, or need to be a bit higher?
I don't think we can go to zero. There hasn't been a small externally funded economy that went to zero the RBA itself has said it doesn't want to go below 1. It could actually launch quantitative easing at 1. I think it probably could go to 50. That's where Canada went. So, yeah, I'd probably say under extreme duress, the RBA would go to 50 basis points, and then probably stop there and look at QE.
Good, very good.
But good, good thing for jumping into.
So I mean, that gives you 100 basis points of easing, which is next to nothing.
4 bullets.
4 bullets, but the banks will be under margin pressure, so they'll keep half. So it actually gives you 2 bullets for mortgage rates, and that would probably not even take you to new lows on mortgage rates.
And the issue we'll have is the foreign lending will dry up, and so it'll be a question of about saying how does the RBA fill that gap.
Yep.
So if we, as David spoke about before, we've got this massive amount of foreign lending coming into basically, people lend us money to go and buy houses from overseas because Australian housing is such a fantastic investment. When they decide that that's no longer the case, we'll still need money to and so there'll need to be this whole quantitative easing or whatever in terms of that. Okay, so policy responses.
Yeah, let's look into policy responses. We've discussed, I think, at some degree anyway.
Yeah,
but let's look at it systematically.
So there's 2 types. There's sort of what I call tactical versions, which is some short-term things you can do to try and in early stages to make sure this is not all falling apart. And then you've got some longer-term strategic ones about how you're actually going to, as an economy, you're going to approach this. So some of the tactical ones. Well, the first one's lower interest rates. Now it's pretty straightforward. The main thing for central banks is all about this curtailing panics and guaranteeing liabilities. So luckily, we've had a dry run to this. So we went through the 2008, and a lot of the things were put in place to try and support the banks. And problematically, a lot of those weren't removed, but that's not such a bad thing if you're going into a crisis, because it means a lot of the tools to deal with it are actually already there. But the key tactical part is needs to be early and needs to be guaranteeing liabilities, letting some things fall over but not others, and I guess freeing up the psyche of the person out there to say, well, okay, it is safe enough to spend money. So providing liquidity is key. So what we saw in the financial crisis was a lot of central banks actually just broadening what collateral they'll take, going from saying we will only accept pristine collateral to saying we'll take any crap that you have on your balance sheet, you can throw it at us and we'll let you lend against that. And so
we've already seen the RBA preparing for that with it has its cash for coconuts facility, but it started with coconuts, and we're really down to sort of peanuts now.
Coal.
Yeah, coal.
Supporting the solvency. Now there's this issue about solvency versus liquidity. So when you have, I'm trying to remember the example, is a lot of the US banks sort of in the Latin debt crisis sort of went through this part where they'd lost all this money on Latin American loans, but because there wasn't this mark-to-market accounting standards, their problem was that nobody would give them money, and they said no liquidity. So that's sort of one type of problem you can have. The other type of problem you can have is the solvency issues about saying, okay, if the central bank's there providing liquidity, so they're pumping money into you and making sure you've got liquidity, you can still be insolvent. So what we saw during the financial crisis was a bit of rule changing about marking to market, but that's one of the things that quite possibly you'd see relatively, or you could, if we see that relatively early, that's sort of a positive sign, I guess, in terms of how they're doing, and basically just saying, well, we know you guys are insolvent, but we'll let you keep going as a bank. The flip side is you can nationalise or recapitalise and things like that. So which is sort of the next stage. So the first stage is going, okay, you guys look like you might be insolvent, but let's just modify the rules a little bit to keep your lending.
I don't think the Australian banks have to mark anyway.
Oh, okay. On the housing stuff?
No.
Okay.
So they've already got that flexibility.
Yeah.
On the recapitalisation, then I think the likely outcome is that would end up either recapitalising or nationalising the lenders' mortgage insurers rather than the banks.
Yes.
Themselves, and so you you can kind of pretend that everybody's solvent by overtaking their insurer instead of them, which is precisely what happened on Wall Street in the GFC when they nationalised American Insurance Group, which was the patsy that had guaranteed all of the toxic assets.
And Fannie Mae and Freddie Mac as well.
Yes.
Yeah. So that's certainly something you can do. I'm trusting this victim narrative as well. Is I think one of the dangerous things when you go into these debt crises is when they start is about who's at fault at this, and if it turns into a those people who lent money that shouldn't have lent money, and we've got to punish. Who do we have to punish? If it comes down to no, we have to punish the people who lent the money, and so let all these individuals go broke, and make sure that they get properly punished, and these banks get properly punished by going broke and all that type of stuff, and then we'll pick up the pieces later. Generally turns into the worst, the poorer debt crisis versus the ones which is no, let's fix the problem, let's try and make sure that people do suffer a little bit and pay penalties, but it's not about a scorched earth. Can we just, anyone who touched any of this stuff, we need to make sure it goes bankrupt, and anyone else is virtuous and will live on, because that's where you get the massive depressions and the downturns.
Okay.
Yeah.
So it's a little bit of a combination of fall guy, but selective fall guy potentially.
Yeah, it needs to be moderated. I think my take is I think the US didn't do enough in terms of it. There was too many people who got bailed out, and too many people who got no one went to jail. All these bad lending practices and all those sorts of things is sort of sowing the seeds for the next one. But that's probably coming more into the strategic side. So this is sort of the tactical responses. The typical responses you get, this is just an example of, I've got a chart up here of a bunch of different ways, whether you're emergency lending, bank liability guarantees. In worst cases, you get to deposit freezes, where you basically just go, okay, nobody can withdraw their money. And so some places have certainly had those types of things. You get the bank restructuring and mergers. A lot of it's sort of getting you, and that happens almost all the time. But a lot of it's going, okay, we've got a good bank, let's let them take the bad bank. And so that we saw a bit of that during the financial crisis. Australian banking is very concentrated already. So we're probably up for more concentration, I'm guessing, if they let that go, and I haven't seen anything sort of suggesting not. So quite possibly, we'll be in a worse position in terms of that front. So during the financial crisis, we saw St George into Westpac, which was, St George was big enough to be almost a fifth pillar type thing. So we lost a fair bit of competition there. Bank West into CBA, a bunch of other smaller ones. So
Suncorp was under the hammer as well, but they managed to get it away with the guarantees.
Yeah, so those are not good for longer term competitiveness, but the short term expediency of keeping the economy alive, I guess. So there's recapitalisation of the banks. You can nationalise them. So we saw nationalisation. We saw in the UK with Northern Rock was one of the worst ones there, and so nationalisations often actually work out relatively well, especially if it's more of a liquidity issues in terms of they just need to match off these assets and keep the thing going, and often the governments do actually end up making money out of the whole.
So just like relaying that across to obviously our situation, would you see then the potential for a mortgage insurer then perhaps to
be nationalised?
Yeah,
exactly.
Absolutely.
Yeah.
That's the backdoor bailout path. Because I mean, if you think about it, the mortgage insurers are insuring the repayments of the highest risk borrowers in the market. Presumably they'll be the hardest hit and the most default, where the rising defaults will be. If the government takes that over, they can simply pay out all the premiums. And it means that their losses in the banks are just fantastically mitigated. And so the banks, it's a real confidence thing that way as well, because the banks simply don't look like they engendered the crisis so much as they did. Now, obviously they did, but all of this will transpire behind closed doors. So
something like Genworth would just disappear off the register, and the problem will go away.
Well, it was originally a government operation anyway. It was privatised. LMI is a highly profitable, highly cyclical, pre-nationalisation crock of shit business, right? It goes through a classic cycle, or boom-bust cycle. So it's just like the US monolines, exactly the same. So, yeah, you'll get all of these dynamics playing out, but they'll happen in the dark, and you'll only get hints of it in the press. Like, for instance, there was an auction for Suncorp during the GFC. Everyone was asked to put a bid in for it. It was never actually sold because it managed to make its way through, but nobody knew.
Yeah, right.
But there was a bank run on at Suncorp. It was bleeding deposits. It was insolvent in effect. But they managed to turn it around with the government guarantees. It raised some debt, and it was okay. So,
and as David said, one of the best things about an Australian debt crisis is we've had the dry run for it.
Yeah.
And unfortunately, we didn't do anything to fix it for the next one. But hopefully we've learnt some lessons about the short-term tactical stuff, and maybe we might
hope so. But I mean, that's why we called this the dumb bubble, is because we watched it all transpire in the GFC. Not only the redress of the bubble, but how it was created, and then 5 years later
we said let's create one of those ourselves.
Let's create it.
So we saw Spain go through it, we saw Ireland go through it, we saw the US go through it, and we just thought, hey, that looks pretty good. Let's take one of those. Where's our bubble?
Well, I think it is a measure of how desperate the RBA and Treasury were in 2011-12 when suddenly China's growth shunted lower structurally and caught them by surprise, and they were like, well, we don't want to carry this bag. So they just hit the gas.
Yep, that's the next guy's problem.
Yeah, exactly. And you'll notice Glenn Stevens is long retired.
That's right. Okay, so strategic responses then, these are the longer term. So you've got some short term tactical things you sort of play with your what you can do. So then you go into your strategic ones where you say, okay, austerity is you sort of four big ways of sort of your longer term growth. So austerity is your first one, which doesn't work, but people love trying it. So we saw that in Europe. They sort of straight away, it's all about austerity. It's all about making sure that we don't spend more than you earn, and their recovery took a lot longer than what we saw in the US. So I sort of probably push that to the side and go, the more you see about austerity and popping up, then as an investor, the more worried you should be about how bad it's going to get.
I'll just add, in the Australian context, I think we will see austerity, because the way it plays out here is, if we see the bad debts and then public debt rising as it steps in to absorb, that private debt that's starting to tower. You will also see fiscal stimulus, obviously, to support the economy. Yep. You're very quickly going to see Australian public debt stock rise from, it's roughly 20%, but it's going to blow through the 20 to 30% ceiling overnight, especially when you add the automatic stabilisers and everything as well. And that's the trigger for a sovereign downgrade. So once we start getting downgraded, maybe not in the heat of the crisis, but shortly afterwards, then interest rates start to rise. There'll be a big push to repair the budget.
Well, especially if Libs aren't in power and Labor is in power.
Well, the Treasury will want to cut because they'll want to stabilise the sovereign rating, because it guarantees the bank interest rates still, and it probably will guarantee them even more after this crisis.
Yeah.
So that's one of the difficulties that will come out of this, is you'll definitely have austerity running at the state level, because they'll be seeing all of their stamp duties unwind.
Yep.
But once you get into the housing bust dimension of this federally, and through, well, not immediately in the crisis, but in the period following the hottest part of the crisis, Australia will have to quite quickly move back to austerity.
And actually, that was one of the issues you saw in the US, was that the local and state governments were pulling back at the same time as the Fed was busy trying to shovel out money.
Yes. Well, and I think that will be the pattern initially, but I actually think relatively quickly we will see all budgets pulling in money in this crisis.
Well, let's hope not, but
if
that happens, that's a sign it's going to be worse.
Yeah.
So printing money is probably one of your key ones. So look, it's got to be a mix of central bank printing and government transfers. I think given the Aussie government debt's quite low relative to other countries. I think you're going to see a lot of government transfers in terms of basically just, as we said, flipping from private debt to government debt. And places you saw, there's lots of places like Ireland's a great example of relatively normal government debt to all of a sudden massive levels of government debt just back on the back of bailing out banks. Debt defaults, so that's quite likely. And then money printing. I'll move more on money printing in a minute. But it's the money printing is pretty key to it. Your debt defaults. So basically saying, okay, are we going to how are we actually going to do this? How are we actually going to restore the credit again? So there's a whole bunch of different ways about who you're saving, who you're defaulting, whether you're nationalising, and all those types of bits, which sort of before. But the broader, longer term one is it going to be sort of fixing the root cause of this, or are you just going to simply restructure it and just spread it over everyone for a bit longer? So depending upon which countries you're talking about, there's a lot of places that basically just go. China's a good example in the early 2000s with a housing crash, where they basically just took all the assets, threw them into a bad bank, and then spread that amongst everyone. Everyone took the pain for that over a number of years, and that worked out relatively well for them. But in other cases, it doesn't work out as well. So it's got to be that whole mix. The redistributing wealth, especially if you're seeing a lot of money printing. So money printing, you see you often see assets go up in value as we saw, and so all of a sudden the richest are getting richer, and you see the rise of these sort of the 1% protests and all those types of things, and so central banking is going to make it worse. Quite possibly you get a sort of, from leftist governments, you get the rise in let's rebalance things and changes to capital gains taxes or different ways to try and get more money. The longer term lessons, I guess, is that redistributing wealth doesn't really, in the past, certainly hasn't really helped, because capital gains taxes don't really help when everyone's sitting on losses anyway. Yeah, they might get some money back later, but it's not really going to make a huge difference. A lot of the rich people are very busy trying to shovel money offshore into various structures to keep it safe. So there's issues in terms of that. But I guess what redistributing wealth sounds good and would be a good outcome, but generally speaking, it doesn't happen fast enough during these crises for any sort of meaningful sort of help to solve the issues. So yeah, onto money printing. Just an interesting graph thrown out that sort of showing the levels of money printing that happened in the US. So this is just a view of 3-year money growth in the US as a percentage of GDP. And it's got basically, for anyone who's just listening to the podcast, we're basically showing that in the Great Depression and the aftermath, for about 20 years afterwards, there was sort of somewhere between 1% and 3% of money growth that the central bank was creating, and then that fell for another 70, 80 years to about 0.5% is a typical bit. So you went from sort of somewhere between double and 4 and 5 times as high. And then in the post the 2008 crisis, we saw exactly that same thing. And so that's all coming down to that, getting that money printing out there and getting the right balance between, fiscal spending and buying back government debts. Because what tends to happen is, and noting that, unless you get these big foreign currency debts, it generally doesn't result in inflation. So unless you get, so people speak about Germany, they had these massive external war debts they needed to pay that were in French francs and pounds. So that was sort of like the driver behind that. And all the South American countries that have run into the problems, tended to have US denominated debt. And so that's where you run into the problems, as opposed to somebody who's got their own currency and can print. So there's those, and also jump onto some of the other policy responses. So during the bubble, this is just a list of what Dalia had as good things and bad things. So during the bubble, you want central banks considering the growth in debt and its effects, using macroprudential policies to target restraints in debt growth, and that was basically the opposite to what we had. We had sort of an encouraging of growth in debt and sort of a no real recognition that double-digit growth for banks in lending every year on year versus low single-digit growth in income was in any way incongruous. It's sort of like that whole no, the banks are banks are good. That's the way banks grow.
Well, there's always a footnote in the financial stability review, here and there, saying, "Oh, there is a risk."
Yeah, that's right. The next one is at the top of the market. What happens? What do good central banks do at the top of the market? Well, they're either they're either using macroprudential or broad monetary policy to constrict the height of the bubble. And then the bad policy is central banks continuing to tighten well after the bursting of the bubble. I think the issue for Australia is it's outside of the central bank's hands. So as David said, they're busily trying to say, no, guys, loosen up. You should let this. If it's criminal lending, that's fine. Just let them go for a few more years. We'll clean it up later in a few years' time. But I think for the large part, the policy responses are out of the hands of our central bank.
Well, they can also see the sort of long-term debt reckoning coming, I think, in the next external shock. Like they're as much focused on that next external shock as they are this endogenous one.
Yeah.
And they want to reload their cannon. I mean, they want to hike rates.
Yeah.
Because they know they've got nothing left or very little. And so the last thing they need is for others to be doing that job for them. But that's the circumstance they've found themselves in, and that headwind is turning into an absolute gale, and so they're going to have to waste what few bullets they have left before they even get to the external shock.
Absolutely. So then you get to the actual depression side. So what do you do once you've actually hit? So good central banks are providing ample liquidity, cutting rates quickly, aggressive monetizations. They're aggressive in fiscal sticumulus. They're probably fast at changing some of the accounting rules to let people get away with it. Systematically important institutions are protected. So if we were out doing that, it's a good thing. If as an investor, you got to be worried if the central banks are slow to cut rates. If they've if all the liquidity that they're giving is reluctant, and it's always just a little bit, this might be enough and it's not enough, and how about this little bit, and it's sort of like it's all dripping out. And if you get governments with austerity or systematically important institutions that fail or are unexpected to make it.
And is this, I guess, a key part of this inflationary and deflationary sort of aspect in terms of so to give you an example, countries that are in a deflationary where they can just go as hard as they possibly would like in terms of say stimulus and central bank mucking around, and so they're sort of a little bit protected against it turning into stagflation.
I think it's very hard for it to be stagflation for Australia, because we haven't got externally denominated debt.
Yep.
The issue is whether we go through a European type one where they had to be dragged kicking and streaming along at every step of the way to saying, you've got to deal with this versus. Possibly Iceland might be one of the better examples, but US where it was relatively quickly put, and so the downturn was less, and you come out of it a lot quicker.
Okay.
Whereas arguably there's parts of, well, not even arguably, there's certainly parts of Europe that aren't out of it, that are still running at 20% plus unemployment rates, and here we are 10 years later. So
Good point. Okay, sure. And then into deleveraging.
Deleveraging. So this is the part. This is the sort of the part where we're a little bit away from this. So I'll flick over this quite quickly. But the issue for once you hit the deleveraging stage is making sure that is remembering that getting your monetary policy right. And actually, let's flick ahead. We've almost run out of time, actually. So
okay.
I might flick ahead to the monetary policy side,
sure.
Which is this sort of pushing on a string. One back.
Yep.
Which is pushing on a string part. So in terms of monetary policy, there's sort of there's three different stages you can go through. Your first stage is your interest rates, which is cut your interest rates and you get to zero and okay, now we're done. Your second stage is then your quantitative easing. So you go, okay, we're going to start spending, we're going to start buying up government debt. The issue with quantitative easing is it works really well at the start, and then its effectiveness fades the longer it goes on. So 10 years into it, or Japan's 20 years into it, it's hardly making any difference at all anymore. So then you need to get to this third step, which is your helicopter drops. And so whether that be, there's been a whole bunch of different ways people have done this. So in debt-backed financial fiscal spending, so Japan, US during World War II, US and UK in the 2000s are good examples of that, where that fiscal spending happened. You can basically go, the central bank can basically just print money to cover debt repayments. So Germany in the 1930s did this, and China did this, where it basically lent money to development banks in China, and then basically said go and spend as freely as you want. So that's sort of basically the central banks basically directly printing money and giving it to people and saying, you're off the hook for having to worry about paying this back.
What about the Kevin 07?
That was a transfer, because that was actually a fiscal transfer. So it wasn't a central bank driven one.
Okay.
So that's certainly a big thing, and Australia's got a lot of scope to do that, because our fiscal debt's still quite low, depending upon how much the lending mortgage insurers cost us in the end. But you can just then you start getting to the stage where you just start literally printing money and giving it to people. So Japan had a little bit of a go at this. There's during the Great Depression, they sort of US veterans just got a big bonus. There's been a number of other ones out there where basically you're just printing money and giving it to people, which is sort of when you get to that last sort of stage. And then you can have jubilees and things like that. So Iceland effectively did that. That happened a lot in ancient times. They'd have a debt jubilee, and just all the debts were forgiven, and off you go again. Unlikely to happen in Australia, I think. Iceland basically only happened because it was just the debts were just so big, there was no way they were ever going to pay them back. But I think there's obviously a certain stage, and you want to see that the central banks are moving through those stages and not dragging their heels at every step. If they drag their heels and go, well, we've cut our interest rates to zero, let's just wait for that to come good, then you get worse outcomes. And if they're like, right, that stopped working, onto the next one, that stopped working, onto the next one. That's where you want to see your central banks.
You need a depression economics RBA, which there's not a lot of evidence of staff in there that have their heads around this.
No, but luckily we've seen the US do a good example, and Europe do a bad example.
That said, Bernanke was a scholar of this stuff long before he was at the Federal Reserve. Where there's some promise in Phil Lowe, who's been very focused on the debt stock and its impacts on monetary policy for many years. But I wouldn't go so far as to say that he's a depression economics guy. But that's what you do need, definitely. I don't know whether you got to import a Mark Carney or maybe Ben Bernanke and his dotage could come down. But the RBA has been existing on ideologies that are going to be severely challenged by all of this.
Yes. Yeah, the other thing to note is that the fiscal monetary tensions is the other key one. So if you've got your government officials dragging back on austerity and all these things while the central bank's busily trying to spend, then they'll offset each other's effect. So if they're working in concert with each other, then you get out of this much faster. If they're not, then you start running into these austerity issues and just can't get the money out, then that's where the crises become worse as well.
Okay, very good.
We might skip past the normalisation. It's too far down the track.
Okay.
Just some quick investor notes, and then we'll wind up, because I know this has gone a lot longer than we expected.
It's been a big topic. It has been a very big topic.
Yeah, it's gone a lot longer, but I think for our purposes, we knew it was quite a valuable, lesson for people to look at. The key bits as an investor is the sooner you see central banks acting, the better the outcome's going to be. As soon as you see, if you get to talk about austerity, you get talk about, and it seems as if they're dragging their heels at all, you want to be out of the market, you want to be short, you want to be waiting until, get offshore or wherever until you actually see some solid signs that they're actually moving ahead.
Okay.
It's very unlikely to be inflationary. You could in theory print enough money, but no one's managed to do it so far, or no one's done it so far, mainly because of the constraints people have put around central banks. It's easy.
It's certainly not going to happen here.
Yeah, certainly not in the first couple of years.
No.
Yeah. you need to note that credit will disappear and needs to be replaced, and that's your key measure is how much printing and everything's going on versus how much credit is lost from the system, and are the two offsetting and actually getting it to the stage where you can see that they've opened up. And so they're your key sort of factors as to whether you want to be investing in equities or when you're trying to pick a bottom. They're the factors you want to be looking at, versus just saying stepping back, because most equity markets sort of take 5 to 10 years to get back to the same levels, but the declines can be quite long if you don't see those reactions. So you're better off just staying out until you see the appropriate reactions. And the other key one you'll see is Aussie dollar falling.
Okay, very good. Any points to note on that one, David?
No, that last one is the key.
Yep.
That last one is the key. Yeah, if you're looking at how to hedge or profit from this kind of crisis, then the currency is your best friend.
Okay, very good. Okay, now let's hear some information about Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency of what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio managed daily by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for Cash Management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. In our new personal superannuation option, we have partnered with Praemium, who is backed by HSBC as custodian and ANZ for Cash Management. We feel these structures are the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating only the areas that are important to you, you avoid missing out on the potentially higher returning areas that you are ambivalent about, which are often ruled out in other broader ethical investment options currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they have experience in. We also offer a complete investment solution for those who don't have the time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. Yes, and as always, I will remind you that our personal superannuation product is here. It's been out now for 4 weeks. It's been keeping me very busy. If you are interested in taking advantage of some of the themes that were discussed in today, or having a bit of a look at what we can provide for you, head on over to our portal, onboarding portal, which is portal.nucleuswealth.com. You can select your ethics. You can do portfolio tailoring. You can get some advice on a appropriate mix of investments for yourself and your time frame and goals. You can also compare fees. I've loaded up over 40 of the major super funds in by fee range that you can have a bit of a look and just really reflect on the fees that are in our product versus where you are at the moment. And of course, you can seek further advice. Coming up next week, same bat time, same bat channel. We are now jumping back in. We were going to do the Australian housing crash this week. However, we thought maybe we'd just preface that with our debt playbook, which turned into a bit of a tome. So it is Thursday the 22nd of November, 12:30 p.m. Australian Eastern Daylight Saving Standard Time. And of course, to watch that live, head over to Nucleus Wealth live webinar page, which you can find through our website. And of course, feel free to ask any questions along the way in that one. It promises to be a fantastic topic. Just finally, of course, we are always, as always, available on iTunes and wherever you get your quality financial podcasts from. On Android, Podcast Addict jumps to mind. Give us a like, 5 stars, or write a review if you like what you hear, and it just helps us get out into the broader audiences out there in podcast land. Just finally, as always, thanks very much for attending. Bit of a marathon session today on a huge topic. I think you'd agree with me. If you'd like to give us a little bit of feedback on our performance, head over to bit.ly/Nucleus survey to fill out our attendance survey, and it also gives you an opportunity to jot in some further topics that you may wish for us to present to you. So on that note, thanks very much for your attendance. I hope you got something out of it. I surely did. And we'll look forward to catching you at the next one. Cheers.